Okay, guys, let's get the show on the road as usual, and let's start with the Fed. Yesterday, you should see in front of you a screenshot showing the statement, the revised statement. Always good to look at the previous statement and then compare notes. So my takeaway was that they talked up the job market, they talked down inflation, and a key phrase here will be, it will be appropriate to raise the target range for the Fed funds rate when it has seen some further improvement in the labour market. And the initial response to this was a bit confused because, okay, although it probably had a little bit in it for those who are more hawkish and calling on a September meeting, but at the same time, those who are of a later, banking on it coming later, will probably be quite happy with that as well, because ultimately they remain very flexible and very data dependent, and particularly the line about inflation falling. We talked about this yesterday in the run-up to the event, the minutes yesterday. The statement yesterday, just saying how this collapse in oil prices in the past month or so will likely have taken down their inflation expectations going forward. So there was a nod towards that, and there was also this vague point which leaves us all kind of on tenterhooks a little bit, talking about how we're going to need some more improvement in the job market. Well, now everyone is around scrambling to see, well, what does some mean? Does that mean two more? There are two more non-farm payrolls releases until the September meeting. So if they come in at 200,000 plus with decent average hourly earnings growth, does that mean that meets their criteria for a lift-off? Or do they need to see more? Do they need better than that, 250,000? So it's very basically left all their options on the table, and I'd say it's pretty much as you were. And looking at the market reaction, we had that initial, if I just get out T-notes, we had that initial spike, as you can see, on the statement. I mean, as usual, what a real chop fest, but gradually higher on that nod towards the inflation, but then lower again once people started to take into account the fact that they talked up the improvements in the job market. I mean, just going back to this, what have they taken out? I mean, so they added in the labour market continued to improve with solid job gains and declining unemployment. On balance, a range of labour market indicators suggest that underutilisation of labour resources diminished since early this year. So there's less slack in the system, so that's hawkish. And yet at the same time, they've removed energy prices appear to have stabilised. Which they obviously haven't, because oil's continued lower. So although the labour market appears to be in better shape, they want to see more, and also with inflation likely headed slightly downward pressure on inflation, I would say, after the recent fall in oil prices, although core CPI remains fairly rock solid at just below 2%. I think with CPI taken as a whole, when you add in energy, we're probably not quite there yet. I think it will be very, very interesting to see what happens if, as I think should we get a rally in the oil markets, in the commodity space in Q4, by the time the December meeting, and we do get that CPI figure above 2%, you might find the market starting to force the hand of the Fed and saying, well, look, inflation's over 2%. And if the jobs market continues to come in decently, then you might see a decent sell-off in T-notes ahead of what is likely to be a Fed statement. So by leaving it so data dependent, it leaves it very open for interpretation from now on at these at the non-farms, the two non-farms that we have before September, for the market to try and decide exactly what it is the Fed are looking for. So I'd say mixed reaction, a little bit of confusion, and all options still on the table. And okay, equities rose a little bit on the news. We had S&P. If I just get out my S&P chart quickly, down here. Not a big reaction. I mean, a bit of a spike down, and then we kind of tried to head higher before consolidating. So just reflecting the fact that the market is not really sure about what this means and what exactly they're looking for on the jobs market front. Interestingly, in the morning read, they were talking about how futures markets have been pricing in a hike in September. Is up. The chances of that happening are up to 42% from 38%. So slightly the market is probably moving slightly more towards a September. And for December, it's now at 74%, which is up from 70% before the statement. So on balance, the market is taking this to be dollar strength. Rate hike is more likely on balance, and so T-notes ultimately sold off, and we had the euro back below the 110 handle. If I just look at, I'll talk about this a little bit later, but just look at this, what a chop fest it's been in the euro around this level, around 110, and we're kind of trading back below it today. So that was the Fed. Let's have a quick look at China Watch. This is the Shanghai comp, looking at the this fib that I've got. We're continuing to bounce around. One well-known indicator of stock market fortunes is the margin debt. So that's the amount of people who are taking out debt in order to invest in the stock market. So the amount of leverage to be invested, and quite interesting, just on Zero Hedge, you can see how margin debt, so basically all these people rushing out, taking on debt, opening up these speculative accounts, and I talked yesterday about all these poor people who bought at the top and are now very upset that the centrally planned stock market rally has failed to kick on just because they bought. And as you can see, as margin debt collapses, so goes the stock market, and margin debt continuing to slide. Just as a comparison, you have a look at margin debt in the US, and well, we're continuing to rise. So the number of people leveraging up on the US stock market shows no sign of collapse anytime soon. If you want to see it as any as an indicator, just have a look at this chart here, just looking at NYSE margin debt versus the Dow Jones Industrial Average. And when margin debt peaks and then rolls over, that tends to spell bad things, because all the speculative hot money that has gone into these markets is coming out as people are facing margin calls, and generally stock markets tend to decline after that. So definitely a bad sign that margin debt in Chinese stocks is declining. So what else is there to report on? Well, it's quite an interesting article as well I was reading in Zero Hedge, just talking about how breadth indicators in Chinese stocks, in stocks globally are, well, they've got bad breath, basically. So 1 in 5 US stocks is in a bear market. So 1 in 5 US stocks is 20% or more below its highs. The last 2 times this happened, on the 10th of October 2014. So Tony's asking the MSCI America, so all American stocks. And the last 2 times this happened, October the 10th, 2014, we had a little bit more of a collapse, but it was basically 3 days before a major stock market bottom, and then we rallied, 200 points after that, pretty much, until our recent high. And the second time it happened, November the 8th, 2012. That presaged. So if you bought November the 8th, okay, you would have had 3 more days of downside, and then look what happened next. Again, the most incredible rally in the S&P. So the fact that such a grand kind of internal correction is going on within the markets, and yet here we are just trading some 30, 40 points away from the highs, probably suggests that we're going higher, and that against all the odds this S&P is simply just internally correcting itself before heading higher. So that 1 in 5 stocks in a bear market has been quite a good indicator for perhaps a bit of bullish movement going forward. A big rally perhaps coming on ahead once this bad breath has sorted itself out. For other markets, well, there's lots of interesting stuff. Canadian stocks, 68% of Canadian stocks are in a bear market. Oh, hang on.
Restart your chart.
Hang on, guys, I'm just waiting for Vas to share the charts. Thank you, Vas. Yeah, so 68% of Chinese stocks are in a bear market, and well, why is that? Because massively dependent on commodities, massively dependent on crude, and we all know what's happened to crude. So 68% of the stock market, the stocks listed in Canada have collapsed. 30% of stocks in Hong Kong are in a bear market. It gets even uglier when you look at Brazil. 82% of Brazilian stocks are in a bear market. And well, that's a reflection. This is another resource-heavy, commodity-heavy country. I mean, they're the biggest exporter of soya. They're big producers of corn. And it's no wonder, given that as these commodity prices have collapsed, so goes the Brazilian stock market. And incidentally, Brazilian central bank raised their interest rates yesterday to 14.25% to combat high inflation. So getting very ugly in Brazil. 82% of Chinese stocks are in a bear market. And 81% of Russian stocks. So all these commodity dependent, no surprise, all these commodity dependent countries are in bear market territory and really struggling. So quite a nice little indicator there. And on the earnings front, yesterday, real mixed bag as far as US stocks were concerned. We had Gilead Sciences beating, but all the while Facebook came in and delivered a slightly weaker than expected earnings. Facebook, incredibly, is 11 years old, and it is larger in terms of market cap than JP Morgan, General Electric, and Walmart. Quite incredible. And as the FT says, well, the reason for that is that it has an annual average growth rate of 39% revenues. And last night disappointed, and its stock was punished down 4% after the close. So watch that trading on the Nasdaq. What else do we have? Well, Siemens, which is responsible for 10%, well, almost 10% of the DAX, just announcing, well, 2% income fall, but 8% sales growth, and of that, almost all of that was entirely due to currency, the weakening euro, and also Sanofi, the French pharmaceutical company, knocking it out the park this morning as well, with sales growth of 16%. But of that, 11.2% of that was due to the currency depreciation, and 20% of the profit growth. They announced profit growth of 20%. And once you took out the currency depreciation, it was actually 5%. So basically, this depreciation of the euro, this is why it's so powerful for stock markets, is that it does wonders for the earnings of these companies they're in. And also, guys, just bear in mind, this is the the DAX 30 index, and 3 companies basically occupying 30% of the weighting of the index: Siemens, BASF, and Bayer. Also on the earning front, we had Shell cutting 6,500 jobs in response to trying to tighten their belt in response to the crude price fall, obviously, and the oil major from Italy as well. RBS surprised to the upside, 27% jump in profits on the back of Barclays yesterday. AstraZeneca beat. And I've got another interesting stat for you. So far this quarter, both in the US and Europe, there have been 426 billion worth of M&A deals completed this quarter. This is on track at the moment to be the biggest quarter of M&A since Q3 2007. So the biggest quarter for M&A in terms of size, sheer size of deals being done than Q3 2007. And what else happened in 2007? Well, we got a stock market top in the US. All these guys rushing through deals right at the top of the market. So you've got 2 contrary indicators there. You've got, firstly, M&A transactions running very hot, and secondly, you've got 20%, 1 in 5 of US stocks in a bear market. So you've got very contrasting signals there. As it is, this S&P remains stuck nicely in a range here. If I'm just looking at it, we've seen this chart so many times. We're only 1 or 2% above the open of the 2015, so stuck in this range for now. So that's earnings season. If we look ahead to today, we've got obviously German data that has been and gone, and now we've got left basically is US Q2 adjusted GDP and earnings from ConocoPhillips and Procter & Gamble. Just quickly about crude, having a really good day yesterday, of course, on the back of that DOE release, just knocking it out the park. And okay, this morning it's been a bit choppy. You see that huge move of, well, almost $2 in an hour, well, just about an hour's trading. So massive move, and now we're just consolidating. So if you think as I do that we're if not we're at a bottom, then we're very close to a bottom in crude. But at the same time, the dollar is going to strengthen. And I know that some of you guys in the live room were talking about how this euro is a dead cert to fall, both versus the pound and versus the dollar. I'd kind of agree with you on that front, mainly because I think inflation is going to turn lower in the eurozone, and also monetary policy differentials I'm not sure we're quite priced in yet. Well, then if you believe that commodities are going to recover, but that the euro is going to continue to depreciate, some people calling for a punchy round parity. I've heard parity, and also Goldman Sachs calling for 0.85 exchange rate euro versus the dollar at the end of 2016. So if you believe that, then you've also got to believe that oil will finally decouple from the euro. And as you can see, look at this chart, they're just very nicely correlated. So therefore, if you get parity, then surely you have to see lower prices in crude. So that's the one issue that I have with going long crude, is that this euro looks very vulnerable. So it's just one thing to bear in mind. I wonder if we do get finally a break of this correlation between the euro and crude. So anyway, I think that's it from me, guys. So a few interesting stats in there this morning for you to digest. Also keep an eye on GDP. This is adjusted. This is our second quarter adjusted. This is our second look at US GDP. Initial jobless claims at 130. And I think that is about it, apart from on the earnings front, ConocoPhillips and Procter & Gamble. Okay, I think that's it from me tonight. Today, I will be in touch. Clearly, I need a holiday. I'm off to Madrid tomorrow, so very exciting. So this will be my last day of the week, but I will be on Hotcom all day, and looking forward to speaking to you guys throughout the day. All right, have a good one. Cheers.